Revelations from my man cave. My name's Jeff Banks and I'm from Property Portfolio Solutions, and a lot of people ask me, how do I use my home in order to buy an investment property? Now there's lots of traps, there's lots of little nuances that you probably need to know that when it comes to investing in property, a lot of people simply gloss over because they got the goal, they don't want to see what happens as we're going along. So, say here we have our house. And again, we've got windows, and we want to buy this investment property over here. I have little or no mortgage here, and I want to buy this property over here. Say my house is worth $1 million, my mortgage is $100,000, and this property over here is $500,000. So if we think about the transaction, I'm going to have to pay $500,000 plus the on costs, so stamp duty, that sort of stuff, right? And I'm going to need to borrow $500,000. So we worry about things like mortgage insurance. Mortgage insurance is normally payable where the bank thinks that the risk that you're giving them based on the property that they've got to deal with is too high, and that number is normally 80% equity. So if we're thinking on that sort of line, we want to eliminate that cost. We think, well, hang on, I should borrow $400,000 here, which is 80% of that number. That's fine. Where do I get the other $130,000? I might very well have a second mortgage here. Now, what that does is my LVR here is still way less than 80%. My LVR over here is 80%. Mortgage insurance shouldn't happen. So if I structure the loan here, make this one interest only because I want to maximise the tax deduction that I've got because this is an investment property, and this borrowing here is only for investment purposes, therefore the interest is tax deductible. I make sure that my interest offset account works against my non-deductible mortgage, paying it off faster and increasing my equity quicker to be able to go and do it again. And I make sure that all the rent is going into there, and the repayments are getting made to that account, and to that account, all from this account here. So that all the spare income I've got is paying off my non-deductible debt. My deductible debt is truffing along nicely, and I go from there. Thinking about it simply, rather than say having one big loan and cross-collateralising the whole thing, don't do that, because that does two things. One, it allows the bank to, when they come to refinance the whole thing, and if your circumstances have changed, that might create all sorts of issues. It also, if you're using a mortgage broker, means that the mortgage broker is going to make more money because they deal in the amount of money that they get lent, not the transaction itself. And it just makes things simpler for the next deal. So if I go then to sell, I can pay off that one, I can pay off that one if I want to and get rid of that, not a problem, and I still don't affect my house here, which this mortgage I might have to refinance. So have a think about things as you're going along. That's the sort of thing that we talk to our clients about at the borrowing stage before they even get into their property to make sure that everything sits perfectly. My name's Jeff Banks. I'm from Property Portfolio Solutions, where your legacy is our inspiration.